Today I wanted to talk about some very big topics: inflation, interest rates and recession. The best place to start is the December quarter inflation report for Australia, which printed 7.8% inflation for the year. The market was expecting 7.6%. But the Reserve Bank's forecast for the trim mean inflation, which is a measure of inflation, underlying inflation, was 6.5%, and that printed 6.9%. That indicated the Reserve Bank has quite some challenge on the inflation front. We've been writing for some time about the importance of services inflation in the overall report. We understand that on the supply side, we will start to see falling inflation over the course of 2023. But the services side will reflect wages growth and demand. But what we found was that services inflation lifted from 4.1% in the September quarter to 5.5% and 3.1% from the June quarter. So services inflation pressures are building. And it's very interesting because we wrote before that we thought that services inflation in the US, which is starting to come down, points to the fact that Australia will be lagging behind the US on this interest rate cycle. So we believe that the US Federal Reserve will tighten rates this week and will then tighten again in late March, and that will be the end of their cycle. So if we see Australia lagging behind the US, we expect that Australia will have more work to do after the US goes on hold. This inflation report does make it almost certain that the Reserve Bank will raise interest rates again by 25 basis points at the February 7 board meeting. But what will be important will be the guidance. And I expect that the Reserve Bank will want to give themselves maximum flexibility with regard to that guidance. Because the things that will really make them move rates again in March will be around wages growth that will be released in the month of February. 22nd of February for wages growth, 1st of March for the national accounts that will also give you a measure of wages growth. We expect those numbers to be quite strong, indicating 3.6% wages growth, up from 3.1%. So that lays the foundation, I believe, for another rate hike in March. After that, I expect that for the April board meeting, the Reserve Bank will take a pause because their focus will remain very much on inflation, and they'll be looking for another refreshed view on the inflation numbers that will come for the May board meeting for the March quarter inflation report. We expect that that will still show trim mean inflation around 6.5%. That's too high for a central bank to go on pause. So I expect that May will be the last tightening in the cycle. After that, we will start to see clear evidence that our forecast that the economy in the second half of the year will basically stagnate under the weight of the very high rates, and particularly with the weak consumer spending, will mean that the Reserve Bank can go on hold, and that will give them encouragement that our target for inflation over the whole of 2023 of 3.7% is achievable. And if that is achievable, then it's likely that we'll see rate cuts in February 2024. So we're saying that rates will peak at 3.85%. Many other commentators are suggesting that rates at 3.1% or 3.35% will be enough to guarantee a recession. So we've got a much higher interest rate profile, and yet we're expecting to avoid recession. And the main reason for that is that this cycle is very different to other cycles, specifically around the consumer. So household sector has accumulated around 250 billion of excess savings. We're also going to be talking about a very tight labour market. The Reserve Bank has calculated that on average, borrowers are now 20 months ahead on their repayments. And even the vulnerable, and there's only 20% of borrowers who are in that vulnerable 0 to 3 months ahead on their prepayments. So under the weight of these high rates in the second half of this year, households will have a number of options. Some will save less. Others will actually draw on their excess savings. We're confident that labour markets will still be quite attractive for strong wages growth and for job availability. So they will also be able to draw upon more income and job security. And these are things that don't normally happen during a period of very weak growth. And they are reflecting those legacies of the pandemic. So I think that those factors will allow the economy to stay out of recession, with the household sector proving to be resilient to these very high interest rates that they'll be facing. Another interesting point is that the Reserve Bank has calculated that the proportion of disposable income represented by repayments associated with loans is likely to be about the same level as it was before the tightening cycle. The difference, of course, is that before the tightening cycle, people were making excess payments into their loans, and after the tightening cycle, the interest component will be higher. Another factor that will help households during this period is likely to be loan flexibility. Because borrowers are likely to retain their jobs, and because the capital component is such a large share of overall loan payments, flexibility around that capital component will also be a factor that will be able to be used. What this says to me is that potentially there's upside risks to the growth story in the second half of the year, not downside risks. But with those upside risks come the risks that we don't get the inflation down to the levels that we think are necessary to achieve the rate cuts in 2024. And if we were to see that happening, then clearly the timing of those rate cuts would have to be delayed. So it's a very, very complicated story over the course of 2023. Those central views that we're giving you clearly have more than normal uncertainty around them. We just need to look at what we saw today with the incredible volatility in retail sales. So it's going to be a very interesting year again. Our central view is, as we said, interest rates up to 3.85, economy stagnating in the second half of 2023, inflation back down to around 3.7% during 2023, laying the foundation for rate cuts in 2024. But there are going to be many, many unexpected shocks to challenge that scenario. Thank you very much.